In exactly 48 hours, a $200 billion institution vanished. A struggling business usually shows signs of decay for years. This bank was destroyed in a weekend by customers tapping glass on their smartphones. The target of that panic was Silicon Valley Bank, the 16th largest bank in the United States. The global markets panicked because the collapse proved a terrifying point. Even heavily regulated financial institutions are entirely capable of sudden death. Silicon Valley Bank operated as the financial engine for the tech world. Roughly half of all venture-backed startups in the U.S. parked their cash there. This chart shows total assets for SVB compared to its median peers. Look at the green dashed line. During the pandemic tech boom, startups deposited so much cash that SVB's assets nearly tripled between 2019 and 2021. When you deposit money in a U.S. bank, the government's FDIC insurance promises you'll get it back if the bank fails, but only up to $250,000. Tech startups don't hold $250,000. They hold millions in cash to cover payroll and operations. Because of this, over 93% of the money sitting in SVB was completely uninsured. If a bank holds cash for thousands of people across different industries, they rarely withdraw it all at once. SVB held massive, uninsured accounts for a single, highly interconnected group of founders and investors, creating a massive structural fragility hidden just beneath the surface. Banks don't just hold cash in a vault. To generate profit, SVB took that massive influx of startup deposits and invested it into long-term, government-backed bonds. Then, global inflation spiked. To cool the economy, the Federal Reserve rapidly raised interest rates. This chart shows the mechanical flaw that caught the bank. When the government issues new bonds with higher interest rates, older bonds with lower payouts immediately drop in value. SVB was suddenly sitting on billions of dollars in unrealized losses. If they held the bonds for a decade, they would eventually get their money back, but if they had to sell them today, they would take a massive hit. On paper, the bank was functionally insolvent. Their decision to lock cash into supposedly safe long-term investments had become a fatal financial anchor. The breaking point hit on Wednesday, March 8th. To free up cash, SVB announced they had sold off a chunk of those securities at a $1.8 billion loss, and they urgently needed to raise new capital. Venture capitalists immediately saw a red flag. Warnings flashed across private group chats, Slack channels, and Twitter, instructing startups to pull their money out immediately. The next day, depositors demanded $40 billion back from the bank in a single 24-hour period. By Friday morning, SVB completely ran out of cash and collateral to meet the incoming requests. State regulators had no choice but to step in and shut the bank down. A traditional bank run involves a physical line of people wrapping around a city block. In the digital age, a frictionless, instantaneous stampede of wire transfers can bleed a bank dry before regulators even know what's happening. Over the weekend, thousands of startups realized their money was frozen. Companies prepared to miss payroll, lay off staff, and potentially shut their doors entirely. By Sunday night, Treasury Secretary Janet Yellen and the FDIC stepped in to halt the panic. They invoked a systemic risk exception, a rare maneuver that allowed the government to bypass the $250,000 limit and guarantee that every single customer would get all her money back. The customers were rescued, but the bank itself was wiped out. The leadership was removed, the shareholders lost their investments, and the remaining assets were sold off for parts. The intervention sent a clear signal to the market. If a bank is deeply intertwined with the economy, the government will cover uninsured losses to prevent fear from infecting the broader financial system. The collapse leaves us with three hard lessons. First, even government bonds can become toxic when macroeconomic conditions shift. Second, digital communication has permanently accelerated the speed at which panic can destroy a financial institution. Third, everyday depositors and massive corporations alike have to understand the strict limits of government safety nets.